All right, welcome to another explainer. Today, we're tackling a massive topic: demystifying technical analysis, basically a skeptic's guide to stock charts. Look, we're taking a pretty contrarian, entirely anti-guru approach here. The goal? To separate hard behavioral finance realities from total chartist fiction. So if you've ever found yourself wondering if those squiggly lines on stock charts actually mean anything, or if it's really just financial astrology, well, you're in the exact right place. Let's get into it.
I want to kick things off right away with a thought that kind of changes everything. Millions of traders draw lines on charts every morning, and here's the uncomfortable truth. Some of those lines work precisely because millions of people draw them. I mean, really think about that for a second. The lines themselves, they probably don't possess any fundamental economic magic. But human behavior, human expectation, that absolutely does.
Section 1. 3 honest reasons charts work.
Okay, so here are the 3 pillars we're going to investigate today. Number 1, crowd psychology. Number 2, self-fulfilling prophecies. And number 3, statistical momentum.
Let's hit that first pillar, crowd psychology. The reality is that human emotions, fear, greed, the classic herd mentality, they literally leave visible, repeating footprints in price action. As humans, we are psychologically hardwired to herd together. Just think back to the dot-com bubble. As our sources point out, a ton of those companies had terrible financial models, but investors bought in anyways simply because, well, everyone else was doing it. That intense optimism, followed by crushing pessimism, creates massive speculative bubbles and severe corrections. And those giant emotional swings, they show up clear as day in the data points.
Now, this next part is honestly kind of mind-blowing. Self-fulfilling prophecies. This is when a price level holds not because of some underlying economic reality, but simply because enough traders believe in it and trade at it. Take classic technical patterns like a head and shoulders formation, or even just a basic support line. They work because millions of traders collectively expect them to work. Think about it. If everyone expects a stock to bounce at exactly 47 bucks, and they all place their buy orders right there, well, guess what? The stock bounces. The prophecy becomes reality entirely because of the behavior it generated.
And listen, this isn't just some fringe theory. Check out this massive number, 70%. Research, especially when looking at cryptocurrency markets, shows that over 70% of traders place significant buy or sell orders right around psychological round numbers. We're talking about massive clean levels like $50,000 or $100,000 for Bitcoin. Because these round numbers carry such immense psychological weight, they create huge liquidity clusters. The price reacts simply because everyone is staring at the exact same number.
So that brings us to our third pillar, momentum. This is actually one of the very few statistically documented market effects that academics formally recognize. Back in a famous 1993 paper by Jagadish and Titman, they defined the momentum effect as the tendency of a security that has been rising to rise further and one that has been falling to fall further. It's largely driven by market inefficiencies, things like the slow spread of new information, and investors just flat out overreacting.
You can actually see this momentum concept playing out over an event timeline. Notice how prices trend over a holding period before they eventually correct. Basically, what's happening is the market is underreacting to new fundamental information at first. That creates this upward or downward trend as the news slowly makes its way across all investors. Eventually, the crowd catches on, they overreact, the information gets fully absorbed, and the price finally corrects. That little window of underreaction, that's the real statistical momentum that chart readers are hunting for.
Section 2, the random walk test. All right, let's do a quick retention challenge. Let's play a little game. If you were looking at 2 charts side by side right now, one is a completely real, actively trading market, and the other is just a computer-generated random walk. Do you think you'd be able to tell which is which? Take a second to really think about it, because our brains are completely wired to find meaning in random noise. It is way harder than you think. A lot of traders will look at completely random data points and swear they see a perfect trading channel or a trend line, when in reality, they're just projecting meaning onto static.
Here's the core difference we have to grasp. A real market is driven by fundamental news and human sentiment. But the random walk hypothesis? It argues that prices move completely independently of their past movements. The uncomfortable reality for a lot of die-hard technical analysts is that without actual market memory, the self-fulfilling prophecies and herd behaviors we just talked about, a lot of these supposedly foolproof chart patterns just completely dissolve into random noise.
Section 3, where the magic fails.
Okay, when we actually contrast the crazy promises of online finance gurus with hard academic reality, the gap is pretty massive. Gurus claim perfect predictability. Academics point to hindsight bias. Gurus try to sell you magic indicators. Academia warns us about data snooping. Data snooping is basically when you test enough random indicators on historical data until you inevitably, and purely by chance, spit out a fake winning strategy. And those guaranteed profits the gurus promise? Often, they're literally just a random occurrence. Look, if you have enough computing power, you can always find a mechanical rule that worked flawlessly in the past, but it's probably going to fail miserably tomorrow.
Let's zoom in on hindsight bias for a second. It is a massive mental trap, and it makes every sequence look perfectly predictable after the fact. I mean, it is so easy to scroll back through a stock's history, draw a beautiful trend line connecting the lowest dips, and say to yourself, oh man, look how obvious this buy signal was. But seeing a perfect trend line yesterday absolutely does not guarantee future returns. Why? Because the market is constantly digesting brand new, completely unpredictable information in real time.
To really grasp how fast that happens, look at how rapid intraday stock prices adjust to CNBC News reports. When there's a positive mention, the line shoots straight up. A negative mention, it drops instantly. The market is reacting in minutes, sometimes even seconds. It just goes to prove that absolutely no technical line, no moving average, no fancy geometric shape drawn on your screen is ever going to predict unexpected, real-world news.
Section 4. Honest tools, not magic.
If you prefer honest tools over magic tricks, subscribe. This series builds chart skills the skeptical way. Because look, while charting certainly isn't some magical crystal ball that could predict the future, understanding the human psychology, the self-fulfilling liquidity clusters, and the statistical momentum behind those lines, that makes you a vastly smarter, way more skeptical trader. You stop trading on guru magic and you start trading on actual market mechanics.
So I want to leave you with this final, provocative question to ponder before your next trade. Are you trading based on the market's fundamental reality, or just playing a psychological game of drawing lines with millions of strangers? Think deeply about the true mechanics driving your trades this week. Thanks so much for joining me on this explainer, and remember to always keep questioning the lines.